So, happy greetings to everyone from myself, Ron William, based at MIG Bank here in Switzerland. And today we are going to discuss probably the most important theme at this moment in time, and that is the bear cycle on equities, the short-term bear cycle, I might add, and related risk market. Today is the 14th of March, 3 o'clock GMT. And we're just going to try and go through this as smoothly as possible. My contact details, just in case I don't have enough time at the end, is r.william@migbank.com, r.william@migbank.com. I'll say it a third time, r.william@migbank.com. Please feel free to email me with any questions or any requests. And also you can maybe follow us, MIG Bank, here on social media, Facebook. They have their own Facebook page. Or myself on Twitter, rwilliam77. There are a few messages that I will actually get back to you on this week, so feel free to message me and I'll be a lot more faster in responding. And if you want to stay in touch with me on LinkedIn, just type in my name, Ron William, and you can find me on LinkedIn and maybe get some updates. Finally, on an ad hoc basis, I do update a blog that FX Street has successfully launched called forexstreet.net. So please feel free to contact me on any one of those forums. Okay, so let's start. Quick overview for those of you that may be attending for the first time to the techniques that I use and have used for over 10 years. My techniques basically focus on market timing, and within that, 3 sections: market cycles, so being able to identify a roadmap for movements in the market into the future, but also correlations between markets. And then swing trading techniques based on patterns, such as Japanese candlestick trade setups, which can be quite good for fast-moving volatile markets. And then last but not least, advanced indicators, primarily the mark indicators, which are very successful for finding counter-trend opportunity. I also use my own proprietary strategies, which I've developed over the years, especially while I was working at Bloomberg, involved with the training and R&D side of the product of technical analysis. Now, just a quick survey. I always like to ask each of you here attending this webinar, this monthly webinar that we've been holding here for well over a year at MIG Bank in association with FX Street. How many of you here have attended webinars before that I've given, and where are you from in the world? We'd love to meet new people. And how many of you may be first time to attend this webinar, and also where are you from the world? So we have one person saying UK, another person saying they've attended before, they're from Germany, another person saying they've attended before, someone from India, someone from the UK, Poland, Florida, Milan, Italy, second time, welcome to you. Several times from Japan, that's late in the night from Japan, thank you very much for attending. Portugal, Africa, UK, we have a wonderful kind of global presence here, as always. And the one key message here is this is a great reflection of capital flows across the world. Money sloshes around from one country to another, from one market to another, from one sector to another. And the great thing having all of you here is just to literally be able to reflect that in the discussion that I give, but also the feedback that you might follow up with in the questions and answers throughout the session. So think about each of the countries that you are from around the world and how these market opportunities will impact you. Tomorrow morning when you hit the desk and you look for a trading opportunity, how will this influence your trading position? Now, just a quick point there, just a legal disclaimer that I have to advise. No information published here constitutes solicitation or offer to buy or sell, and very simply, it's for informational and educational purposes only. So if we just keep that in mind throughout the session. Okay, so this is just a quick overview of what we're going to cover. I may deviate, and that is my tendency according to maybe how the discussion flows. Part 1, market update. I'm just going to quickly kind of go through some of the big moves and talk about the potential outlook for the second quarter of this year. So the second quarter of this year is quite important. Then part two, we talk about macro cycles. A big part of my work is looking at market cycles, and I just want to let you know what that means for Western equity markets, related risk proxies, but then also other ideas. Trading opportunities is more of the same, but I'm just going to be a bit more specific and talk about the US dollar, gold, and Japanese yen. Incidentally, the next webinar scheduled for April is going to be covering the Japanese yen, one of the biggest movers this year, Japanese yen and the Japanese equity market, one that I hope each of you here are watching very closely. Okay, so I want to start off with a sentiment gauge. There's been a lot of fast moving in the market recently, especially yesterday. We had a big move on the Western equity market. S&P and the Dow moved very, very quickly, very fast in one session, popping above, extending above their old highs. European markets are looking a little bit kind of relatively underperforming, but holding kind of progressive recovery moves. And then some of the Asian markets are unwinding from extremely oversold conditions, having been hit the hardest. They fell the fastest and early on in the cycle, so it only makes sense that they start to push up higher. And then we have various proxies like Eurodollar targeting that 130 level. Again, Aussie dollar looking like it's about to target its 200 moving average at 104.04 and potentially parity beneath that. And then we have gold also having sharp moves to the downside below the 200 moving average, and oil following suit after a big move above that $100 level on West Export. So that is just a quick snapshot of Western, Eastern equity markets, related risk proxies, specifically on the currency front, Eurodollar, Aussie, and Japanese yen, as I mentioned at the very beginning. But then also a little bit on commodities such as gold and oil. Now, based upon these market moves, I want to ask you specifically to the equity market. Are each of you here bullish into the second quarter of 2012? How many people say yes? Just a quick, if I could just encourage some of you just to say yes, no. Are you bullish in the second quarter of 2012? Or are you bearish into the second quarter of 2012? Okay, so if I could just get a quick response, bullish or bearish in the second quarter of this year. I really want to be specific to quarters. Bullish or bearish? There are many reasons to be bullish, because you can just expect previous trends to extend even higher, which is obviously what we're seeing on the equity market. Or do you think that the equity markets have had their time of upside momentum, and that we should see some healthy pullbacks in the equity market? Some people are saying neutral to bullish. Some people are saying yes, you're bullish on the dollar. Neutral, but I think they'll grind higher. Bearish, not consulted crystal ball yet, so very good response there, Voiki. On which currency? I'm referring mainly to equity markets, Western equity markets. And then some people are saying Bernanke, Draghi, so US, European central bankers are likely to pump liquidity back into the market as per usual, and so they'll not be bullish there. Dow Weekly is very bullish run. Okay, so good response. So quite a fair bit of you are bullish, and that makes sense. So the sentiment survey today here on FX Street webinar is broadly positive for the equity markets, and that makes sense because we've had very strong up move yesterday, but also just generally we've had a great upside recovery above the old highs. So if we just expect more of the same, we can continue to be bullish. Some of you are a little bit concerned of the downside risk as we continue to push higher, because nothing in the market moves in a straight line, and it only makes sense and it's only natural for these overextended markets to maybe have a healthy pullback. Some of you are talking about the US dollar and various other related markets most of you have said that you're bullish on the US dollar. Okay, so my quick theme, which I've mentioned in the very first webinar I gave in 2012, January 2012, is that this year was more than likely to be a game of one quarter and the second half. So in terms of those of you that were very bullish on equity markets and general risk proxies, such as the currencies that I mentioned, euro dollar, Aussie dollar, and commodities like gold and maybe oil, the best times for these markets which have high risk appetite, the trends which have been pushing up so far, is the first quarter of this year, which we just passed, and the second half of this year. But the one concern and caution that I highlighted, those of you who attended might remember, was that the second quarter of this year is likely to produce a lot of downside pressure and a lot of the markets which have pushed high over the last few months. Is that clear to everyone? Just want to make sure that it's clear. So my strategic kind of perspective for this year was that things would remain positive for the first quarter and the second half of the year, but the second quarter would be the big question mark where we would see increasing risk for a healthy pullback or a dramatic setback of some sort on the high risk appetite market, Western equity market, specifically in the US, and some of the related risk proxies such as euro dollar, Aussie dollar, gold, and oil. Good question here. Greg's asking 20% pullback expected. I would say at the moment a minimum of 10% pullback on the US equity market, potentially more. I'll give you an example of how we saw a very fast move on the S&P 500 July of last year, where it actually fell 18% in just 2 weeks after a very bullish period. Someone's saying 2 weeks to second quarter. Yeah, so we're not in the second quarter yet, but we're fast approaching it. And there are a few cycle dates which I will highlight to you. The one to note down in your book now is the 17th to the 19th of March are cycle dates to keep in mind for potential event risk in the market, where we might see some sharp setbacks in the market. 17th to 19th of March. There might be, it might happen just before that or just after that, but that is a time window, a cycle window, where we might see some further exhaustion and potential setback in the market. Okay, so just a quick overview on the theoretical cycle that I'm talking to you about. This is a long-term cycle overlaid with medium-term to short-term cycles. The big fat blue line is a long-term cycle, turquoise is medium-term, and the short-term is the red dotted line. And I'm basically saying that theoretically the economy is roughly here. We've already peaked on a long-term cycle, and we're on the downswing of that long-term cycle. 2007 obviously was the top, where it was the end of all the good times, the boom times that we saw in Western economy specifically. 2009 was the major low that we had in the equity market and just generally in the economic cycle of Western markets after we had the big financial crisis, the first part of it. And as Arkia just said now, 2008 deja vu, I do think that we are going to get maybe another level of the 2008 crisis, where we had a massive deleveraging across markets. People had to basically close down some of their trades to pay their bills, and that is likely what we're going to see across some of the risk proxies into the second quarter of this year and maybe beyond. 2011 was an extension of the recovery, as some of you remember, but then we had a few black swan events like the Japanese earthquake and revolution in the Middle East, which stunned the market and created a bit of a shock. And currently, kind of 2012 Q1 was a little kind of upswing period, and it has been positive. We've had very good runs on the equity markets. I mentioned the Western equity markets, especially the US equity market, pushing to new highs and having a very sharp surge literally yesterday. But the question is Q2, second quarter that we're about to approach, what will happen? I think this is what will happen in the second quarter. We'll have a healthy setback of up to 10% on the US equity markets and maybe more. European markets, I think, will maybe stagnate within their sideways ranges, or maybe revert back to those sideways ranges in some examples. And potentially the Asian equity market may unwind a little bit, having had a very good surge to the upside. Certainly Japan fits that picture. But I think Asia generally leads us out into the future on the upside. Okay, so just want to answer a quick question. Do you not feel that unprecedented money printing will distort cycle geometries? Very good question. All this economic and political influence into the economy and into the financial market can prolong cycles or exaggerate cycles, but under no circumstances throughout history have they been able to change cycles. And so this is a very important point that I want to make to you. Political and economic influences, as important as they are, do not change cycles. They can exaggerate them or magnify them. And this is something I feel quite strongly about throughout all the analysis I've done on cycles. So I hope that answers your question, Fernando. Another person saying, I saw a video on Bloomberg, Tom DeMark, saying that he will short the S&P at 1343. It has gone further up. It has, and there have been a lot of DeMark exhaustion signals on the S&P across multiple time frames, weekly and monthly. But just keep in mind that these markets have just continued to stay higher. It doesn't mean that the risk is not still there. It is still there. But like you said, yeah, a few people, including myself and Tom DeMark, you mentioned, have called for a potential correction earlier than expected. I think we still hold that opinion, but it's, as always, a question of timing. Okay, so keep in mind that the cyclical nature of what I'm describing to you here affects economic growth and contraction. This is an example of cycles on economic growth in the US, and this is US GDP, quarterly GDP, but I've thrown a lot of annotations on here. Some of you might remember this chart. I'm just throwing it up here because it's a very important point. US GDP, whenever we drop below that zero line, that red dashed line, for 2 consecutive quarters, negative quarters, that is a sign of a recession. And keep in mind that if we do have a setback of more than 10% on the equity market, or a spike in oil, given the geopolitical risks that are approaching in July, and many other tail risks, maybe Europe contagion getting worse, whatever. If any one of these black swan events hit the market again, it could be a recessionary event. And just keep in mind that recessions are natural. They happen on a regular basis, as we all know. And the key point I'll make here is that the 2008 and 9 recession that we had was the fastest contraction that we saw since the Great Depression. In the second quarter of 2008, GDP dropped by minus 8.9%. In the second quarter of 2008, GDP dropped into negative territory by 8.9% and surprised the hell out of a lot of market experts around the world. The recession lasted for 18 months, and it was quite a deep, protracted recession, and maybe for that reason, a sustainable recovery was inevitably unsustainable. And certainly we've seen the weakest expansion since World War II. Even though we do have positive GDP, it hasn't been that sustainable overall. And just look at the 1980-82 example, where you see here a potential historical parallel for a double dip recession. So I won't say any more about that, but just keep in mind these market moves will affect the economy. Currently, the economy is doing its very best to recover from a very low base, from a very deep recession in 2008 and 9, which triggered the fastest contraction, minus 8.9% in the second quarter of 2008. So these moves can happen pretty fast and move against popular opinion. Out of about 70 economists around the world working for the biggest banks, the consensus opinion is that US GDP stays around 3% or 1% as a worst-case scenario. Not many people in the market, if anyone in the big institutions, is pricing in any type of negative growth or recession this year. And I think it is important to look at both sides of the trade, not just to have a one-way trade without an exit strategy. So that's all I have to say about that. And so the big question mark is, do we see anything like that in 2012, a potential double dip recession or just negative growth? time will tell. Okay. Any questions on what I just mentioned? Just maybe save it until the end. What did you take on the 7-year cycle? Let me come back to that. But just one point I will say is the chart I showed you on US GDP actually has a 10-year cycle inbuilt, a 10-year and a 4-year cycle. And I tend to use these long-term, medium-term cycles as a proxy, business cycle. Okay, macro cycles. I'm just going to quickly talk about what second quarter of this year might mean for volatility and what it means for the real markets out there, Western equity markets. So let me launch into that quickly. So the big thing I want each of you to keep in mind is whatever market matters to you the most, what you want to know, and I'm guessing what you are most interested in, as I am, is what is going to happen to volatility. Volatility has been historically low. As you can see here, this is a chart of the VIX, which in my opinion is signaling a rise in volatility. But the VIX, when I printed this chart a while ago, was pushing to extremely low levels from, into, under the 17 mark into the teens, the comfort zone levels, from a very high drop. So remember, the VIX index, the sign of volatility on the S&P, was trading around 45 and even higher than that. And over the course of several months, it dropped dramatically. Now, obviously, we've seen an increase since, but my point here, very simple point, that volatility is likely to increase very quickly, very soon. So it would be better for you to be on the cautious side and maybe try and lock in some profit, or just be a little bit conservative on any money that you would have made in the market, specifically the equity markets, which have moved the highs the quickest. Now that's one point. Volatility signals a rise. But the second point is seasonality. Now part of my cycle work focuses on seasonality. Every market, and volatility for that matter, has a seasonal performance that we can measure. And what this shows is that the spring months of each year tend to be the times of the year when volatility increases. So you can see here, March to April 2011, big spike in volatility. 2010, April to May, we had a big spike in volatility. So beware of the spring months. So I would say as we approach the end of March, certainly April and May, keep in mind that we're likely to get a big increase in volatility based on the VIX and any other proxy that you look at. And the famous market phrase is sell in May and go away. We may need to sell earlier than that, but keep in mind this is a well-known financial market proverb, mantra belief, that equity markets tend to sell off into the summer period. And so before the summer, during the spring period, second quarter, we are likely to traditionally see an increase in volatility and a healthy setback in the equity market. Now, someone just asked the question, why volatility is so low while the Dow is so high? And this is a very important point. Isn't that interesting? And that is interesting in that that's partly why the equity markets are doing so well. Because volatility is so low, people's comfort zones are very stable. We all feel comfortable because volatility is low. So we think that we can trade day in, day out, make money tomorrow and the next day, and go to sleep at night very peacefully because volatility is low. So when volatility is low, it increases our optimism and it increases our conviction in the market. We feel smarter and we feel like we can make more money, and so we trade more. And so for that reason, this buy and hold type of mentality it has developed on the equity market specifically, and more so within the US stock market. Does that help? So low volatility increases optimism and greed in the market, specifically the equity market, and that is why we have seen markets like the US S&P and the Dow Jones Index reach new highs, even though volatility is quite low. Low volatility increases our confidence in the market and increases our capital investment in the market. That's the long and short of it. But of course, keep in mind that when volatility increases, we become more uncomfortable and we withdraw our money from the market. We scale back our trades. Maybe margin calls are being triggered, and we get scared, and it creates contagion. So even markets which look great fundamentally, increasing volatility just makes us scared, and we scale back. So keep in mind both sides of this equation of volatility. Now, another point is sentiment. Now, this is a chart of the S&P 500 updated just literally half an hour ago. And here I'm showing you the S&P, punching to new highs. You can see there's a big bullish move that we had yesterday, that strong bullish candle. But keep in mind extreme optimism that tends to appear at market tops, or tends to even signal market tops. And this is an example here on the S&P 500, where we have sentiment examples of whenever there has been a Greek deal confirmed. So whenever, all the kind of complications that we've had within Europe, primarily kind of led by the Greek default risk, whenever there has been a positive Greek deal, it has tended to mark market top. And this was true back in autumn of last year, and more specifically in July of last year. Now, the key example I want to draw your attention to is July of last year. July of last year, days after we had a finalization of the Greek debt positive support, so things were getting better in Greece according to the news headlines, the market did capitulate 18% in 2 weeks. Now, this is just an example of extreme moves that could happen over the weeks and months ahead within the second quarter of this year. Keep in mind the market can move fast. And it can move fast at an extreme optimistic stage in the market. This fits in with a very important subject called socio-economic analysis, developed by Robert Proctor. You can find it on EditWave International or related websites. But basically, just keep in mind that it's important to keep track of trends in social optimism and pessimism, and putting the context of these big headlines, positive and negative, in a correct way so that you can make successful trading decisions. So try not to trade all the positive or negative headlines immediately, because it can be quite emotional, it can be quite false, and you do need to kind of understand how positive headline or extreme optimism can create a contrarian signal in the market. And that's what the study of socio-economic analysis helps you do. It helps you put context on these extreme moves and how society ebbs and flows around these extreme moves in the market. Now, a question here is on your volatility chart. Two questions. Were you using Bollinger Bands around price level? Yes, is the answer. Using Bollinger Bands and the difference between the Bollinger Bands, the spread, to measure deviations in Bollinger Bands. So it's a good way to measure volatility or the VIX. And the second question is, do you find TD sequential to have value in setting expectations for VIX? Yes, I do. I use the VIX across all markets and related proxies such as the VIX and even economic indicators. Keep in mind that Tom DeMark's indicators measure momentum exhaustion, and that momentum can exist on price, on volatility measures of price, or even on economic indicators. So I use it on all of those. Yes. Thank you, Mike, for that question. I hope that helps. Is that okay, Mike? Okay. I shall move on now. Now, the other thing is look for non-confirmations across the market. Now, I haven't included all the charts I want to include here, but one of the key charts is the Dow Jones Transportation Index. So we all know that the Dow Jones Index has punched new highs, just as the S&P 500 has. The U.S. equity markets are generally doing very well. But a very key rule within classic technical analysis, if you pick out your dusted old textbooks from many, many years ago, is looking for confirmation on the Dow Jones Index and transportation. So this is an old guideline rule of Charles Dow, one of the grandfathers of Western technical analysis, which basically makes an economic point that although the Dow Jones Index, which is a representation of the large cap stocks within the USA, are doing very well, so economic stocks are doing well, the transportation stocks, so the stocks like railway and freights and airlines, which are proxies to actually move this economic growth around the country is actually pushing lower, not pushing high. So there's a non-confirmation, and that basically suggests that although we're getting very positive results from these large cap stocks pushing to new highs on the Dow Jones Index within the U.S. economy, that is not being seen across the country or across the economy. So it is being isolated, and that usually suggests a divergence, which usually suggests a setback of some sort. But of course, we do need to wait for confirmation. So keep in mind the Dow guidelines developed by Charles Dow, one of the grandfathers of technical analysis, and that just basically says that if you do see new highs on the Dow Jones Index, you really should see a confirmation of those new highs on the Dow Jones Transportation, because that tells you something about the economic situation. Economic growth is being facilitated around the country. In this case, so far, it isn't. Is that clear to everyone? So someone's saying daily Dow and Dow Jones seem divergent, but weekly chart, 2 Dow Jones Index, no divergence at all. Use one. Which one to use? It's up to you, but I would say keep I use the long-term chart to give me perspective, but nowadays, of course, look at your intraday, look at your daily, because that's where you're going to get the fastest move, the more intraday moves showing up. Use both, and try and use both to get a confluence of signals. I wouldn't say one or the other. I would say look across multiple time frames, because they all give you a good perspective. Okay, now from a cycle perspective, I want to say something about the technology sector and the NASDAQ market. And this is something I featured in the CNBC interview a few weeks ago. You can watch that. I can send you the link if you just send me an email. And this basically calls for a cycle turning point. This is a long-term weekly chart on the NASDAQ. So cycle turning point any given week. I was a bit early to make this call, but it does suggest that the market which has risen the most, technology sector, or the NASDAQ, is likely to turn soon and fall the hardest. And one of the great proxies that you can use here from a news perspective is, historic IPOs. And what is the biggest IPO which is actually taking place at the moment? Facebook. So all of you that love Facebook, the big Facebook IPO, which is now, I think, around the $100 billion mark, when the market is at a top or at an exhausted extreme, it does potentially act as a contrarian signal. So similar to the example I showed you about optimism, extreme optimism at a market extreme, such as the Greek deals, which have signaled contrarian turnabout. This could also be the situation in the technology sector with big IPOs such as Facebook, which is about to take place over the next few weeks and months. Someone's saying are you going to say how it all fits on FX? Yeah, I'm going to mention FX just right at the end. Someone's saying daily down, okay. Although I don't disagree with your transportation as a health indicator, something to be aware of is disruptive capability of the internet. Software and services don't need physical transportation. I agree with you. The old kind of classic rules for the Dow confirmation, there's always a heated debate as to how relevant it might be within this kind of new age evolution of technology, where we do have other proxies which may act as a transportation index by themselves. But just keep in mind, there are very good examples of how Dow Jones Index and transportation have produced good signals. I'm going to just speed along because I'm just being told now that there's someone that's going to come on around 18 minutes to go. I'm almost done, but I hope that answers your question. Just point on the Dow. Okay, so just quick point here. NASDAQ cycle turning point. We've pushed to new highs. I think that is temporary, and that we will see a turn in the next few weeks. I think we might see it first in the NASDAQ before we see it in other markets, and certainly the NASDAQ is likely to fall the fastest and the hardest. So we're likely to see dramatic moves in the NASDAQ. The fact that Facebook is undertaking a historic IPO during this time, I think, is not good for Facebook, although we all love Facebook. and just keep in mind that it could serve as another contrarian signal alongside the extreme optimism that we've seen following the Greek debt swap that happened last week. Okay, now just an example of the technology sector going a little wild and crazy. The stock that everyone loves the most, Apple. Every time I speak to any one of my friends or colleagues, Apple is the stock that comes up on their mind, especially with the new iPad, which is coming out, or has already come out, I'm told. But look at the stock. It's just had a fantastic run. It's approaching the 600 level. And the only point here is just keep in mind that the proxies such as technology sector and stocks like Apple, IBM, Yahoo, these big large cap stocks have done so well, but during this potential downside risk period in the second quarter, they may actually fall the fastest and hardest. Just look for potential reversals and potential mean reversion. I would say potentially into the 200 moving average, which is a big move by itself. We could see some big setbacks on large cap stocks like the Apple on a very stock specific basis. Now, part of the reason why I think all of this is likely to happen is just keeping in mind risk reward. Just from a very simple level, this chart here is a theoretical chart which I designed a while ago, showing you how stock market prices or just general market prices rise and fall. But during that time, the red line is your risk reward ratio. And usually we build up a conservative risk reward ratio where we don't risk that much and we make a conservative amount of money. But then at some point when the market starts to accelerate, we risk a lot more to make a lot more. And it gets to a certain stage where it's unsustainable and when we're likely to lose a lot of money if we don't at least protect our profits. So what I'm trying to say here is I think that one of the key reasons why we might have a healthy pullback in the equity market, Western equity markets and US equity markets, and also related risk markets like Eurodollar, Aussie dollar, and maybe gold and oil, is because the market had a good run and people may start to lock in profits specifically on the equity market and maybe deleverage on the risk markets just because it becomes a contagion effect. Okay? I hope that makes sense. Now, this will create a rotation of performance from the US to Europe, and this is a ratio here I'm showing between the S&P 500 and the Euro Stoxx 600. So I'm trying to do a like-for-like comparison, apples compared to apples. And this ratio here shows you that the US equity market is likely to underperform the European equity market for the simple reason that the US equity market has done so well for so long over the last 2 years or so. Europe has underperformed mainly because of the default crisis, the contagion effect which has taken hold of Europe and set fire to credit default swaps and various other issues that have been taking place in Europe. But that is likely to change. And US, something as big is going to happen to the US soon, according to this chart, and potentially Europe may actually start to surprise into the summer of this year and start to outperform the US. So watch out for a big change in a traditional story. Europe likely to outperform US and US likely to underperform Europe. To actually watch this, just bring up a ratio of the S&P 500 and Euro Stoxx 600 just to monitor that. Now, key point here is just we are in a relative world, and the example I always show is this picture of a forest full of trees which has caught fire. So everything is affected, the United States, Europe, United Kingdom, and Asia, but it's a relative world, and we're looking for those markets which are likely to outperform on a relative basis. So going back to this metaphor of this forest fire, we're looking for the trees which have been burnt the least. We're looking for the best out of the worst. And right now, Europe may actually start to look the best out of the worst over the next few months. So keep in mind, European equity markets and just Europe generally, from an economic perspective, might start to stabilize over the next few months. US is actually likely to get back into the contagion effect, where we actually get a rotation of risk back into the United States. So who knows, it might be subprime related, might be the banking sector. There's a whole bunch of tail risks that might actually be triggered in the United States. Now, very last point I'm going to end off is trading opportunities. I've already mentioned a few in terms of, locking in some of your profits on the equity market specific to the US equity market, and being very cautious on related risk properties like Eurodollar, Aussie dollar, and gold and oil. Currently on my model portfolio here in MIG Bank on our report, I am short on Eurodollar, short on Aussie dollar, looking for Eurodollar to push below 130, looking for Aussie dollar to push back into parity at one level. Long on dollar yen, for obvious reasons. It's had a massive move, 10% since late January. 10%, one of the biggest moves this year so far on the upside. And gold I'm short, and oil I'm watching at the moment. So that's just an idea. Someone's saying it is a year of election for USA, and that is a reason to be bullish on the market. But I will make one quick point here about the election cycle and how that might be positive for markets. Keep in mind that it is positive because we believe that during election years, the government pumps in more money into the economy and basically allows the economy to do better, and the stock markets tend to outperform. But, Solomon, there's one point that I want to make to you. There are exceptions to the rule. The rule is that election years are positive for the market and for the economy. The exceptions are the year 2008 and the year 2000. Can anyone tell me what happened in the year 2008 and the year 2000? Were they good years or bad years for the economy and for the equity market? Just a quick trivial question. The year 2000 and the year 2008, good years or bad years? Okay, so Gan's saying bad, and I'm sure some of you, Greg's saying bad, Fernando's saying bad. So just keep in, Quattro's saying bad. So just keep in mind, the rule is election years are positive for the market because governments are likely to pump more money into the economy, which is positive for the financial market because they want to get re-elected, so they want voters to be optimistic. But there are exceptions to the rule, and I think maybe this year might be a bit of an exception. Also, keep in mind that some political commentators are saying that this year is maybe a leaderless election. There aren't real clear divides between the politicians which are being elected, and so for that reason, maybe the economic policies aren't that strong this year. The other point I would make from a seasonal perspective, based on election years, the positive momentum from elections might actually appear in the fourth quarter of this year. We might not actually see any positive momentum from the election recovery until the fourth quarter of this year. So keep in mind that just because it's an election year doesn't mean that all the quarters of the year will be positive. I think more than ever, it means the fourth quarter might be a positive quarter. Okay, I hope that's clear to everyone. So now I just want to quickly go into part 3. Thank you for that question on elections. Someone's just asking, Mike's asking, does your analysis expect 10% correction in Q2 come early or later in the quarter? I think it'll be early in the quarter. The market mantra is sell in May and go away. I think we will sell earlier than May. And right now I think it's the end of March into April and May. As I showed you on the volatility chart, these months tend to be positive for volatility, negative for the equity market. Also keep in mind that there's a big cycle event risk date which I'm waiting for, and that is the 17th to the 19th of March, plus or minus 1 to 3 days. 17th to 19th of March coming up soon, where there might be potential event risk in the market. That's just something to keep in mind as a near-term cycle point. Okay, now just a quick point I want to make on related proxies. Gold, the precious metal, which everyone loves to own. I've been bullish on this in the long term, bearish on this on the short term to medium term. Please make the distinction between the two. I'm a long-term gold bug. I'm bullish on the long term, and I do think that gold will push above 2,000 and much higher next year and the year after. But over the short to medium term, I think we're due downside risk, and that downside risk is likely to be over the next few weeks and months into the summer of this year. So I think the summer of 2012 will mark a major low for gold. Please, I've had a lot of clients ask me questions on this, and sometimes there's a little bit of misunderstanding. I'm bullish on gold, but I'm waiting for a buying opportunity, one of the best buying opportunities, into the summer month of this year. If you have any questions on what I've just said, I can send you a report, television interviews, and feel free, I can send you real-time answers on my Twitter account, rwilliams77. Okay? So please feel free to ask me questions on that. Now, the point I want to make about gold is gold has been a safe haven market for so long, and we all know the argument about fiat currencies losing their value, and so people are feeling the need to invest in gold, and also it's a hedge against, political and economic risk, and maybe inflation risk, and so on and so forth. So we all know the arguments for being bullish on gold, but there's one problem. These are all macro long-term arguments, and on the short-term basis, gold is going to be driven by speculation, and that speculation overran when gold was approaching the $2,000 psychological level. The market moved too fast, too soon, and like any market, it was due a correction. We saw a big correction, a 20% move in 1 week, 35% move on silver in 1 week, so big dramatic setbacks on gold and silver. And since then, I've maintained that on a cycle basis, based on an intermediate cycle basis, there were downside risks for gold, and I've gone on the record on this. Some of you might actually remember. Now, right now, I've maintained that while gold holds beneath $1,810, the downside risks are strong and they are growing. And we have already seen a $100 setback last week on gold, which was quite a big move. And I think that was a big alarm bell to all of you guys that were bullish on gold, that you know what, there are people in the market right now that are being squeezed on gold, and I think on based on various money flow data that I look at, people are offloading their gold positions on the short term. They're being squeezed out of the market, and just technically, they're just exiting out of the market just for a few months. So just keep that in mind. Now, if we're going to move below 1600 and 1530, my objective is 1460 and 1300. 1460, 1300. US dollar, I believe, continues to move higher as all the risk proxies move down. I think this is a deflationary story, and so as the equity market pull back in the second quarter, along with related risk proxies, the US dollar is likely to be the champion market, and US dollar will outperform other currencies. So euro dollar down, Aussie dollar down, dollar yen up. And that's my last chart, dollar yen up. Dollar yen, this is a big story I've been calling for, a 40-year major cycle reversal on dollar yen, but it's also Japanese yen generally. And dollar yen is the sleeping giant. It is up 10% since late January. I'm making a big noise about this because those of you that would have traded this would have made some good money, especially if maybe you hedged using an option contract. But just keep in mind that dollar yen is going to be a very good performer over the next few weeks and months because of the double positive effect of a US dollar story as safe haven flows or flight to safety develops back into the US dollar, and as the Japanese yen reawakens and starts to depreciate. Keep in mind that the Japanese equity market, the Nikkei, is also up 25% since late January. So that's a big move, 25% on the Japanese equity market and 10% on dollar yen. So dollar yen is a currency to keep in mind. That's it for the session. My mantra, as always, is enlightenment to realize knowledge. It has been an honor and a pleasure sharing this discussion with you, and I hope each of you have felt a little bit enlightened through this, and certainly have trading strategies to develop from this webinar. Please, any questions that you'd like to ask or request a chart or research, just email me on r.william@migbank.com. We're also available on Facebook, Twitter for real-time response from me. rwilliam77 is my Twitter account, and on LinkedIn, if you want to stay in touch, Ron William on LinkedIn, and for blog updates, forexstreet.net. Now, we have a 1-month trial for our reports. If you would like to receive that, our daily reports and special reports, just email me. I can also email you media interviews that we've given. And please, stay tuned for our next webinar on the 11th of April at 2 p.m. GMT, Japanese yen verging on a major cycle reversal. This was, I went on the record and called this in early November of last year. Some of you have already congratulated me. I think Fernando has kindly done so, one of our clients, I think. But just keep in mind, this has been a big call that we've made early November for a big reversal in Japanese yen. We've already seen that. This is the sleeping giant awakening. So I'm going to give an update on the Japanese yen cycle, strategic price levels and technical signals. How does the US dollar effect and safe haven flows influence Japanese yen? And then just a quick point about relative performance. What are the best FX trades to profit from when looking at Japanese yen? So the next webinar is on the 11th of April at 2 p.m. GMT UK time. Please stay tuned and attend then. We would love all of you to attend, and if you have any friends that would be interested, please invite them. I'm more than happy to share the discussion with them. Thank you very much, FX Street, and thank you very much, each of you from around the world. It's been an honor and a pleasure. Ron William, technical strategist here at MIG Bank based in Switzerland. Thank you very much, and happy Pi Day. All the best. Thank you very much. Enlightenment to real life knowledge. Bye-bye.